Welcome, Low VA Rates Nation. Wonderful Good Friday afternoon to you. Happy Easter weekend to everybody. Before we start, I got to give a shout out to my daughter Elizabeth. Her and the Rhodes College lacrosse team are on a bus traveling to Sewanee, Tennessee to play their arch rivals in their quest for a perfect 15-0 conference season. So good luck, Lady Lynx, this weekend. So back to the purpose of our task today. We talked last week about, some of that credit card debt and how it revolves and it costs us some money. So this week our topic is the principal reduction with a VA hybrid arm versus a 30-year fixed rate. Most households, our biggest expense each month is our cost of housing, and that is the same if you rent or you own a home. Today we're going to go down an example where you have a 30-year fixed mortgage versus a 5-1 hybrid arm through the VA and what the advantages are of that. Because that biggest expense, you're working probably maybe almost the first 2 weeks of the month or the better part of the first 10 days of the month just to cover that mortgage payment. So for this example, we're going to say, all right, we're going to use a $350,000 loan amount. Maybe you have a mortgage that's smaller than that. Maybe you have a mortgage that's bigger than that. One of the big benefits of a hybrid arm, we have the conforming loan amount limit of $424,100, and a lot of times these 30-year fixed loans, they have increases to the interest rate when you go over that. Big benefit of our hybrid arm is you do not have those increases, so you can get a great rate on this. So today we're going to do an example of saying we have a 3.75% interest rate, and you would like to see just what's possible for a 2.75 5-1 hybrid arm. So we look at the differences. The payment on this loan amount with a 3.75 is roughly $1,620. And we got lucky today. The payment if you had a 2.75 is almost $200 less. So you're at a plus side of an extra $200 each month that you could do a lot of things with. You maybe want to take that $200 and keep making your same payment and pay your principal balance down faster. You may want to pay off some credit cards. You may want to pay off a car loan faster. You can almost use it as a personal financial tool. So when we look at that and say, okay, what would our balance be if we went 5 years into the future on this? Your balance here is going to be $315,000. And on this side, we're going to be at $309,000. So by using a hybrid arm, you're going to keep making your payment. You've gained $6,000 of increased principal reduction during that period of time. Now think about it. We've got this extra $200 up here, and maybe this applies to you. If you take that, multiply it times 60 months, you'd have another $12,000 that you could put towards this equity here. It would actually take it down to under $297,000. Compared to where you would be at, look, you would almost be $18,000 more in expenses during this period of time. So the way it happens is a hybrid arm allows you to have more of your month's payment go towards principal versus interest. For example, on the first 5 years, your first payment on a 30-year fixed, 67% of your payment goes towards the interest on the account. That's why banks love to have 30-year fixed loans, because they're going to be on the books forever, and the majority of it goes towards interest. You don't really get to a 50-50 split between your principal and interest until month 142 sometimes on a 30-year fixed loan. You can have that same benefit on day one with the 5-1 arm. So here you actually have a much more rapid decrease of your principal balance because of the way that interest is applied versus principal each month. Hybrid arm is a great way to maximize that payment each month because we work hard, right? Every time when we come into the work, we're in there, we're doing great things. We want to make sure that we're making our mortgage work just as hard for us. So I want my mortgage payment to come in here and pay this principal down so I can maximize. I'd rather have $18,000 because I don't want to go home and try and justify to headquarters, aka Mrs. Lewis, about why we are not taking advantage of $18,000 more in equity during that 5-year period of time. I know it's a lot of information to grab in a Facebook Live post, so if you've got questions on this, or if you would like us to actually customize a solution for you, maybe you would like you've been in this mortgage for maybe a year or two, and you would say, God, I don't want to start that term over. Guess what? We can do a 28-year mortgage for you. Because we're all about taking care of America's veterans, because we've done the right thing, we've raised our right hand, swore that oath to the Constitution of the United States to defend it. We want to defend your mortgage payment against paying too much interest and use the VA hybrid arm. Remember, this is guaranteed by the Department of Veteran Affairs. The VA exists to take care of veterans. They're going to create a product that they feel comfortable by providing to the veterans. So please, if you've got time over the Easter holiday weekend, go onto our website, lowvarates.com, put your information in. We'll give you a call on Monday and we will prepare a personalized quote for you. Thanks everybody. Have a great Easter weekend.